Hi everyone and welcome to Retirement Planning in Canada. This is a very exciting video and I hope this helps you achieve financial freedom in your retirement. So let's start with it. So if you divide retirement planning into two parts, it is basically accumulation phase and deaccumulation or distribution phase. So this is the retirement planning model that financial planners work with. So what happens when you're in the working phase, when you have a salary, when you are running a business, when you're like drawing some wage, if you're a contractor or something like that, you are in the accumulation phase, that is working phase. You start building your assets, so you start creating investments, you buy your house, you start paying the mortgage, so you start building up your assets during the accumulation phase of retirement. Now, vesting date is the date on which you decide to hang up your boots. So, as the saying goes, that is stop working. So, when you stop working, you're in the deaccumulation phase or distribution phase. So, in the distribution phase, you're not working anymore. So, there is no income source from your salary, from your wage, or from your business. So what do you depend on? You depend on those assets that you have accumulated in the accumulation phase. So in the distribution phase or deaccumulation phase, you live off on your investments, you live off on the house that you have built up. Okay, so retirement planning distributed into two stages: accumulation phase, where you have income from salary, wage, or business. This income helps you in creating wealth, so wealth creation is the focus. You contribute to your pension plan and investments, as well as like to housing, let's say, to build up your assets. In the distribution phase, you don't have any income from salary, but you have income from pension plans, government, and investments. Your objective is to preserve your wealth, right, and distribute that wealth, right, yearly through pensions. And finally, you make withdrawals from your pension plan and investments to live off. Okay, so just to like summarize, in the accumulation phase, how do we accumulate for our retirement? So we pay CPP deduction. So CPP is Canada Pension Plan. When you're working, every paycheck you make a deduction towards CPP. Now this deduction, right, goes into a fund that is managed by the federal government. So that fund is managed for you, right? And when you retire, you start taking payments from that fund. Then you probably would buy a house in your income phase and start paying mortgage on this house. So you take on a house, you start paying the mortgage, and you start creating something called as home equity. Then you also might be contributing to your employer pension plan. So your employer might be having a pension plan that you would be contributing to, as well as you would be making investments for your retirement. So all these things happen in an accumulation phase. You pay to the government for your pensions, right, in form of CPP. You pay mortgage and you build home equity. You contribute to your employer pension plans, and also you make investments for your retirement using tax-free savings account or RRSP. Okay, in the distribution phase, there is no source of income from salary and wages. So what do? You depend on the government in form of CPP, old age security, and GIS. So government helps you out in the retired phase when you have retired in three ways. So they provide CPP payments to you. CPP is when you're working, you contribute into a plan, and when you retire, you take out from the plan. So it is contribution based. Whatever you have contributed, how long you have contributed, that will determine your pension from CPP. Then old age security is an additional benefit that the government gives, right? If you have, it is based on residence. So how long you have lived in Canada and whatever is your income level, based on that, they will provide you old age security. Guaranteed income supplement is to retirees who are below the poverty line. So government provides additional support to people who are below the poverty line. So this is one source of your retirement funding. The other source can come from home equity. So home equity means you build up a big house when you are in the earning phase, and most people in the retirement phase downscale. Downscaling is they sell their expensive house and move into a retirement condo or an apartment, a smaller apartment. So you encash on the difference between the house and the apartment. Okay, you can also access it without selling using something called as a reverse mortgage. Reverse mortgage is reverse of mortgage. In mortgage you make payments to the bank. In a reverse mortgage, bank pays you funds based on your home value. Then there is employer pension that you might be receiving. This could be another source of income for you, or you could have income from investments that you have made during your working age. Okay, so we are going to discuss each of these, right, in little bit more detail. So what is CPP? CPP is a government plan. So you make CPP contributions when you're working. So example, the maximum annual pensionable earnings, right, is 64,900. So if you have income more than that, you will be restricted to this much amount. If you have income less than that, the CPP contribution will actually be based on your income. So basically what do you have to know about this CPP plan? That each month you will be contributing and your employer will be matching your contribution. So in total 5.7% of your salary you would be contributing into CPP. So maximum a person can contribute is $3,500 if he is employed, or if you are not employed, you're self-employed, then maximum $7,000 is roughly $7,000 is what you can contribute in 2022. Each year it keeps on changing. So basically 5% of your wage, right, or if your income is higher, then it will be lesser percent will go into CPP. So your contributions go into a fund that is managed by the federal government. It has around $500 billion. It is well managed. So it has generated 10.3% annual returns, average returns in the last 10-year period, or 8.7% returns, right, if in the last 5-year period, because the fund has come down because of like inflation and stuff. Okay, and it is like well managed. So if you see projected asset that it is projecting, it is on track to achieve each of its milestones. Okay, so it's a well managed fund. So what happens? You contribute in your working age. When you retire, government is going to pay you. In 2022, the maximum payment is $1,200 if you are 65 years. And average payment that a person gets is $727. So roughly, if you even consider the average payment, right, a person is going to receive $700 from the government as a pension relief. Now, if you take early retirement, you get little bit less CPP. So 36% less CPP if you retire early. If you delay your retirement, you'll get higher CPP. 8.4% is added to your like every year if you delay your retirement. The second help that the government gives you is old age security and GIC. It is not contribution based, it is residence based. So if you have lived in Canada since the age of 18 to 65, then you will get the maximum old age security payment of $618. And it also goes down if your retirement income is above this threshold. So it is residence and income based. If you are making a lot of money in your retirement, old age security will go down. If you are not making like a lot of money, then you will receive old age security. If you have an income below that, then you will receive additional payment from GIS. If you are below poverty line, then government provides additional payment to you in form of GIS. If your spouse or partner receives the full old age security, then like if you're filing taxes combined way, then your GIS payment will be little bit lower, right? So old age security and GIC both are based on residency in Canada, how long have you stayed, your age, right, when you start taking the old age security, and it also depends on income in retirement. So this government help in form of CPP and old age security actually contributes only 20 to 35% depending on your lifestyle of your retirement needs. So it does not cover all retirement need that an average Canadian has. It covers somewhere between 20 to 35%. If your like expectation from retirement is very high, you want to live a lavish life, then it might cover lower. If you have plans of modest retirement, then it might be covering little bit higher. But the important point is it does not cover the entire retirement needs of an Canadian. So what should you do about CPP and old age security? So CPP is a well-managed plan which is indexed to inflation. So this is important. If the inflation goes up, the payment goes up in the retirement. So you make maximum contributions that you can. If you are employed, you don't have any options, it is deducted. But if you are self-employed, then please make contributions to CPP. There are a lot of other benefits like disability benefits, spousal benefits of CPP that makes it a very valuable plan for Canadians. And try to keep, for old age security, try to keep your taxable retirement income when you retire within the limits that would be there on retirement. So try to use like things like tax-free savings account to accumulate funds, because then those funds don't become your income. Okay, so that is one way of keeping your retirement income lower so that you can avoid old age security clawbacks. Clawback means if your income goes higher, they will reduce your old age security. So this is one help that you get in the retirement. Second thing that most people use, right, as a part of their retirement strategy is to buy a big house when they're working and to downscale when they're retiring. So what's the process? You buy a house in the accumulation phase, you pay the mortgage over the years, right? You might also consider prepayment to pay it off early. Your objective is to become mortgage free in retirement, so your mortgage goes to zero. So the whole home, right, is your investment now. So your entire home, because the mortgage is zero on that, becomes your part of your investment. Now that home you can either downscale, right? So sell a big house and move into an apartment and then cash on the difference, or you can go to a bank and take a reverse mortgage, in which the bank keeps the title of your house, and against that title they will start making you some monthly payment. The important part and why this is useful in retirement, if you're planning to do this, if you're planning to buy a big house, then eventually work your way through mortgage, pay it off and use it for retirement. One important thing to note, there is no taxes, capital gain taxes in Canada on primary residence. So when you sell your primary residence in your retirement and downscale, you do not have to pay any taxes. Okay, so I have shown an example of it, so we'll just work through that example quickly. So example, so this strategy, I have put some numbers behind it so that it explains it a little bit better. So let's say the value of your house is $600,000 today. Okay, your current age is 30, your retirement age is 65. The real estate appreciation has been around 7% per year in Canada. That's the average. It's 6 point something. I have rounded it off. And there are selling commissions and closing costs that are roughly around 10% of the property value. Now, you have found out that you don't need such a big house in your retirement. So you might need a smaller place when you retire, an apartment, right? So you found out that a comparable apartment is around 400,000 in your city that you would like to live in when you retire. right? So you can see there is a difference. The value of your house today, maybe your family is bigger, you need a lot of space, is higher than what is the potential place for your retirement. So how does the home equity strategy work? So you will keep your house, you will start making mortgage payments, try to become mortgage free. This house will keep on growing, right? There is real estate appreciation. So if we assume that this house grows by 7% per year, then your value of the retirement house will be somewhere roughly around $6.4 million when you retire. Okay. Now, let's say you're utilizing the strategy of downscaling. So you sell this house and buy a smaller apartment. So 6.4 million is the value of your house. When you sell it, you would have to pay closing costs, that is roughly around 10%. So $640,000 as closing cost. Like real estate commissions are 7% and plus some other fees and charges. So value after selling commission is $5.7 million. Now, this place that you want to buy, right, the smaller place will also have appreciated. So we have to calculate the appreciation of this price of this condo, right, on your retirement date. So value of retirement place will also go up. So that is around 4.2 million. So there is a difference. You're selling a bigger house and moving into a smaller one. So you can encash somewhere around $1.5 million of home equity, that is the difference of these two places, and contribute this value into your retirement fund. So this is the basic strategy that people follow in their retirement. Most Canadians do that. They buy a bigger house when they have bigger families, pay off the mortgages over the years, and when they retire, they downscale to encash on that home equity. Now, if this is a primary residence, the good part is there are no taxes on it. So this will be completely tax free. Now, this Google Sheet, I am going to make it available under with this video. So you can find out your own strategy. So let's say my house is right now 800,000 and I want to move in a place that is, let's say, $500,000. If you're living in let's say Vancouver or something, like the dynamics would be different. So 800,000 is the value of my house. 500,000 is the house that I want to move in my retirement, the current prices. So this calculator will work itself. You don't have to do anything, and it will show you how much fund will go into your retirement account based on the numbers that you have inputted. So just key in value of your home and value of the place that you want to live in your retirement. You can also change this, the age, current age, retirement age, right? And this thing will calculate itself. So we'll return it back to what it was, 600,000 and 400,000. Okay. So this is one source of funds that will help you to retire. You should use that because primary residence is tax free, plus you need a place to live. So rather than paying someone else's mortgage, when you're renting, you could stay in your own house and build it up towards your retirement. Okay. Now, along with that, your employer might have a pension plan. So employer pension plan are basically divided into two parts, or divided into two types: defined benefit plans, which are very rare right now, and defined contribution plans, which are more common these days. So in a defined benefit plan that your employer might have, your pensions are fixed. So pensions are, let's say, 1.5% to 2% of your maximum salary, right, into number of years worked. Okay. So let's say I have a salary of $100,000 on retirement and I've worked for 30 years. So at 2% rate, that will be 2% into $100,000 into 30, that is $60,000. And these pensions are then indexed to inflation. So if inflation keeps on going up, your pension per year is going to increase too. Defined benefit plans are very rare these days. You might get defined benefit plans if you work with the government or with some unionized jobs. Other than that, you don't have defined benefits anymore. Most employers have moved to defined contribution. So in a defined contribution, there is no fixed pension, but employer matches your contribution that you're making in the retirement plan. So let's say $5,000 you're putting towards retirement, the employer will also match that $5,000 and add it on to a common kitty. The contributions are then invested in an RRSP or a RPP, registered retirement savings plan, or a registered pension plan. I have a separate video on these accounts, so if you are interested, watch those videos, right? I cover in details what an RRSP is. And then these funds grow over the years, and when you retire, you draw pensions from them based on how much they have grown. So pensions are dependent on how much investment returns do you get. So if you go to the second sheet, okay, that is employer pension estimation, you can use this sheet to estimate how much pension you're going to get, right? If you have a defined benefit plan or if you have a defined contribution plan. So I've given some examples. So current salary, let's say 60. So let's say we are doing it for a couple. One person has a defined benefit plan, the other person has a defined contribution plan. So let's say one person has a salary of $60,000. Number of years until retirement is 30 years. They have 30 years to go. Pension percentage that the employer is providing is 1.5% for every year you have worked. That is generally the norm right now, not 2%. So 1.5% is what the employer is providing. Their salary is expected to grow at 2% and there are 30 years to retire. So when the person retires, their salary will have grown by 2% per year and their salary will be somewhere around $108,000 considering a 2% growth rate in salary. Now, based on this $108,000, they would get 1.5% for every year that they work. That is 1.5% into 30, 45% of 108, that is 48,906 will be their pension. Now you don't have to worry about these rules and contributions and all such stuff. You just fill in your details. So let's say my salary is 70,000. Okay, I have 35 years to retire. And salary growth rate and all. Try not to change it unless you want to. Okay, the employer provides 1.5% for every year. Then your expected salary will be 140 and your pension will be $73,000 when you retire. This is a defined benefit plan. Not many people have it these days. This is not a common plan anymore. If you have it, it is worth in gold because the pensions are fixed. You can plan around it. Then defined contribution plan is little different. So based on your current salary, you put something in your account, right? Retirement account. The employer matches that share, right? So let's say $6,000 is your salary. You put 5% of that in your account. So $3,000 per year into your retirement plan. The employer matches that. So provides $3,000 extra. Both of this is invested, let's say for the next 30 years. The salary growth rate is 3%. So each year the contributions will keep on growing. The investment generates 7% rate of return. So you would have somewhere around $700,000 in your retirement account when you retire. So this is an example of a defined contribution plan. The pensions are not fixed, but right, your contributions are fixed over the years, and whatever you get depends on how the investments have performed. So a source in retirement for to cover your expenses would be coming from your employer pension plan too, if you have one. If you do not have one, it goes to zero. But if you have one, then you could use your employer pension plan to fund some part of your retirement. Okay. Along with that, you can also plan your own retirement, right? apart from the government help, apart from home equity, and apart from employer pension. So you could start investing in a tax-free savings account or a registered retirement savings plan and invest in different things like stocks, bonds, mutual funds, exchange traded funds, REITs, GICs, and build up your investment account that might help you to retire. Now, all these things, how to do? Like what are stocks, what are bonds, what are ETFs, what are common ETFs to buy or to look at. All these things I've covered in different videos over the period. So please watch those videos, right, to know more. Also, like I have videos for tax-free savings account as well as RRSP. So also watch them for a higher understanding. Okay, so I've given a Google sheet to help you to do that. So example, so if you go to tax-free savings account RRSP estimator, you can put in your current balance in your TFSA. You can put in how much yearly are you investing, your current age, your retirement age, and the expected investment return. The fund, like this calculator will find out how much you will have in your TFSA. So let's say some person has $77,000 in your TFSA. They put on yearly investment of 6,000 and the fund grows at 7%. So they should be having $1.6 million in their account. If a person has like 15,000 in RRSP, right, and their yearly investment is $2,000, then they might have $436,000 in your retirement. So if you change the numbers, it will calculate it for you. So for example, I have $20,000 in RRSP and let's say I'm putting $3,000 every month. So it will calculate how much you will have in your, this should be RRSP. So I'll change it to RRSP, a small typo. Okay, on retirement. So use this calculator to find out how much you will have if you have something in your TFSA and you plan some yearly investments. Okay, now if you put it all together, so what's going to happen? So in today's term, you would have a certain lifestyle and you would want to maintain that lifestyle in your retirement. So you would have yearly expenses as a, let's say as a couple that you have today. Now those yearly expenses are going to grow by the rate of inflation. So you will get certain expenses on retirement that you want to cover. But right now your expenses are getting covered by your salary or wage or business income. You would not have that when you retire. So your expenses you have to cover. Now you don't have to plan for all. Some part of that will be covered by your employer pension that you might be getting. Some, if you have a defined benefit plan, then part of that will be covered by government like CPP and old age security. So you would know the expenses that you have to cover on your own, right? From that you can calculate if you invest at a certain rate, how much retirement fund you need to cover those expenses. That retirement fund doesn't need to be accumulated. You have home equity, right? Some part will come from home equity, some part will come from like pension accounts that you have with your employer, some part will come from existing investments. So difference you have to plan for, and for that you can start a monthly investment. So we are going to use this flow, right, and create a retirement plan for our own selves. So if you go to the last sheet, retirement planning tool, I have put in it all together. So what's happening? The couple has expenses of $100,000 per year, right, based on their lifestyle. They want to cover that. The inflation rate is 4%. Both of them are in the 30s. They want to retire in 65. I'll zoom in a bit. The life expectancy is 90 years. Both of them plan to live till 90. So this expense of 100,000 will not be 100,000 when they retire. It will grow at the rate of inflation. So if inflation is considered to be 4%, they would need $394,000 almost every year to fund their similar lifestyle. Now they don't have to plan for all of it. Currently, CPP on an average pays $8,000. Old age security pays $8,000. So total government benefits right now are 16,000. But these benefits are indexed to inflation. So when they retire, they should expect $64,000 out of this 394,000 to come from the government. Now, they might have a defined pension plan from employer. So I have used this pension estimator that we worked on, right? So this one, so let's say one person has a defined benefit plan and they get $73,000 from it. So that will show up here. So you just change the numbers there. If you have 0, put 0 here. Okay, so defined benefit plan a person has between those two couples, so $73,000 is covered from that. So they have to not plan for 394, but they have to plan for 256, because some part of it government is covering, some part of it employer is covering. Okay, now 256 is the yearly expense that they have to come up with every year. So let's say the investment return is 4% and inflation rate in the retired years is 3% for them. So they would need $5.7 million in their account, right, to get $256,000 every year, right, in their retirement. So how do they accumulate this amount? Some part will come from home equity. So you can change the values in home equity estimation. So 1.49 million comes from home equity. So if you don't have a home or don't plan to have a home, put 0 here. So that is one part. Employer pension account, you might have an investment account with your employer. Some amount will accumulate there. Then tax-free savings account, if you have anything, if you are investing in it, that might accumulate some value. RRSP, if you're investing, again, these calculators, the values are coming from that. Change the numbers here to get your own numbers. Okay, that leaves you fund that you want to accumulate. If you invest at 7% from today, right, till your retirement, assuming you're 30 and plan to retire at 65, you should accumulate, right, you need to have $600 of monthly investment to achieve your goal. So this is retirement planning, how it works in Canada. It's a little bit different than other countries because not all of it we have to plan for. So based on your expenses today, change the number here, put your current expense here, play with it, right? You will get how much would you need when you retire. Also, you can change age and retirement age. If you're, let's say, 50 years old, then it will change. Now, some part of that will come from the government. So that calculation will happen automatically. So you will get expenses that you have to cover based on what you need minus government provided and employer provided pensions. Then if you're planning for this, you will create a fund, right? So $5.7 million is needed. So some part will come from home equity, some part will come from employer pension, right, account if you have one. Your existing investments will yield you certain thing, then you will get fund accumulated, and if you invest at a certain rate, you will get how much monthly you need. So let's say instead of 100,000, I just need $90,000 as a couple. So if you put 90,000 here, the figures will change. So you need $161 that you want to invest. Okay. So use this calculator to plan for retirement. So this is retirement planning in a nutshell. So what are the different key things that you have to remember? So key things to remember. First thing, you don't have to plan for everything. Contribute into CPP, that is the government plan. Like stay in Canada, create your residency, build up your residency, and make sure that your retirement income is not too high. If you do all these three, then government is going to help you to cover 20 to 35% depending on your lifestyle of your expenses. Now for the rest of it, if your employer has a matching program, please utilize it, because that is an additional 5% you're getting from the employer. Max out your matching program at your employer. Then if you are buying a house, buy a bigger one, right? Build your family into it, scale down, right, in your retirement, and cash on that home equity. That is part of your retirement. Next, if you are planning like investments, use tax-free savings account, use RRSPs to accumulate funds so that you can retire successfully. Now, if you want to go into details of what an RRSP is, what a tax-free savings account is, there are a lot of videos available. There is a separate section on like how to use your house, how to invest in real estate. So that is also available. So please watch previous videos to know more about it. Thank you so much and see you in the next one.